Okay. So I left off because I wanted to take the proper time to go through the capital dividend account. Now, we're not going to do the whole CDA here. Okay, it's not necessary to do the whole CDA at this time. I'm just going to have a quick review here. So the capital dividend account, we will do it in 256. So the capital dividend account, or CDA, represents the ability to flow tax-free amounts. It's a flow-through account. It's a notional account. It doesn't mean real dollars. There's no bank account called your capital dividend account. And it allows you to flow tax-free amounts. What are the two sources of CDA credits? There are two original sources of CDA credits. What do we have here? Where can you get a CDA credit from? That's it, right? So the tax-free portion of a capital gain, sale of capital property, and the life insurance death benefit in excess of its ACB. Okay, and only life insurance, right? Not critical illness insurance, not disability insurance, not business overhead expense insurance, not accidental death and dismemberment benefits. Only true life insurance contracts generate a CDA credit, okay? And like I said, there's a lot more to do around CDA. That's good enough for our purposes. So basically, the CDA credit is the death benefit, the total death benefit paid minus the ACB. Now, if we compare on the last slide what happens with your net cost of pure insurance, your net cost of pure insurance is this hockey stick type of growth. It's going to look like so. Just the same way that mortality costs increase as you get older. Shouldn't be a surprise. The trade-off here then is with what happens to the ACB of a typical insurance contract. And again, this is what you had pointed to earlier, Chris, if I'm not mistaken, that the ACB for an insurance contract is going to look something like this, okay? And so we get this thing that we sometimes call NCPI grind, and that is that high NCPI, as you get older, ends up grinding your ACB down to zero. So if you happen to live long enough, eventually your ACB for an insurance policy will hit zero. That's good. So we grind that thing down. Okay. Questions there? All right. Now you can see what happens then under G3, because if you've got a rated policy under G3, now your NCPI is going to go at an even faster pace. That's right. And it's going to grind your ACB down at a commensurately faster pace. So you're going to have an accelerated NCPI grind. Does that make sense? Okay, and I don't know how much you care about that. I've seen a couple of arguments for actually finding a way to dispense with grandfathering under or from G2 to G3. So to trigger some sort of underwriting and deliberately get a policy moved into the G3 regime, maybe where you have an older smoker, for example, who has made a serious investment into their life insurance policy. Arguably, it might be worth it for this person to re-underwrite in order to move over to the new regime and bump up that CDA credit. Okay. Any questions there? Now, personally, for personally owned policies, we generally want that higher ACB is better, right? And generally in corporately owned policies, generally a lower ACB is better. And really the way this thing works is the ACB rules become really an anti-dump-in provision. You can take this sort of morbid example. If you've got a business owner, age 66, and finds out he's terminally ill and dumps, let's say, $100,000 of corporate cash, retained earnings, whatever, into an existing UL contract, well, what's going to happen? It's not a wise move necessarily, because you're going to increase the ACB by $100,000. And it won't increase the CDA credits. Okay, that's really the dump in this is designed to prevent. Does that all make sense? Oh, we lost Chris. All right, hopefully he comes back on in a moment. Taylor, you buy all that? Okay, and it's nothing complicated, right? It's the kind of thing that really we're just taking a string of concepts and stringing them together, right? We understand ACB, we understand NCPI, we understand the CDA credit, and now we can see how the three kind of play off against one another. Okay. Now we've already done this, and we've already done this, so nothing shocking there. And then we look at our non-exempt policy. So I've already covered off most of this already. So now a policy fails the exempt test. We already saw how to manage this. And what happens is this makes the policy taxable, okay? And we really should understand what this means. Your book has some examples of this, but they're a little bit artificial. I actually, I wish that the book used kind of more real to life examples. I think sometimes they use these examples that are, I don't know, kind of miss the point a little bit, I'll say. So this is your exempt test. And now you have a policy where the cash surrender value ends up way up here. Sorry, now account value, I should say. Okay, so the account value ends up over and above what it was supposed to be. Okay, so we've failed the test now. We don't fix it within the 60 days. And that can happen because the insurer, now today, most insurers do what you said before, Danny, they just get you to check off. Is yours actually automatic, or do you have to check off the box to do the automatic increases? So when you buy the policy, you say, yeah, I give you permission to do the automatic increases. Oh, good, you're back, Chris. Yeah, oh no, all right. Let's just give Chris a second here. Okay, Chris, I just brought you off mute for a minute here. Yeah, I can hear you on your end. I'm putting you back on mute. Okay, on the illustration, what about on the application, Danny? Okay. Okay. Yeah, I would hope they would. What I've seen done here sometimes is an agent who doesn't know what that box means, which you shouldn't have that happen. You did the LLQP, right? And the LLQP has this in it. The agent sometimes just doesn't check it off because of carelessness or because they just don't know. Yeah. I would hope that an underwriter would pick it up. Yeah, I'm just gonna, sorry. Just gonna put him back on mute. Okay, sounds like there's fun going on behind him though, doesn't it? All right, good stuff, thanks. All right, there's fun going on here too though, isn't there? So the exempt test then, for whatever reason, we don't fix it because maybe the agent was careless in filling out the app, or maybe because we chose the side fund or shuttle fund option deliberately, and then the client didn't respond, or whatever the case is. That's typically, it's the rare circumstance where I've seen this, and I think most insurers today would not let this happen, but whatever, I've seen it happen. So if it's not fixed in 60 days, then what happens is this amount, the first thing we have a disposition of the policy. So number one, we have a taxable policy disposition. And that taxable policy disposition means that you pay tax based on the cash surrender value less the ACB, and that gives you a taxable policy gain. You'll note that that is not restricted to the amount over the exempt test, okay? So it's not just on the non-exempt amount. That's good. And then going forward, any new gains over the exempt line are taxable, okay? And because these are all policy gains, there is no special tax treatment here. You already got your special tax treatment when we let the insurance contract grow on a tax-deferred basis up to that line. So there's no capital gains here, no capital gains treatment, no dividends or anything like that. It's all just regular income. That's good? Any questions there? Okay. Now, how does it happen? How did you fail the test? Talked sort of administratively about how you failed the test. What had to happen to the policy in order for the test to fail? Okay, so you could have overfunding beyond what you're allowed. Or even if I chose the automatic increases now, what's the other thing that could happen here? Could happen that your investments actually do too well. Okay, those are the two things that could cause you to fail the test. Now, the third thing that could cause you to fail the test is a decreasing face amount. Okay, so there is that third event there, the possibility of a decreasing face amount. All right, any questions? Perfect. I hope it's something you never have to deal with. Like I said, it can happen. I haven't seen it on newer policies. I've only seen it on older policies, and especially when you look at investments doing too well. Well, now with sort of 8%, so really your investments would have to do very well for this to happen. You've got 8% allowed policy or allowed face amount increase. Call it roughly a 3% MER. You're allowed a little bit of increase anyways, just because you are getting older. Okay, 3.5% under the new rules is the sort of rate of return that you're allowed to achieve. You'd have to be getting about 15% or greater really to run the risk of doing this, and you'd have to be funding your policy to the fullest extent. Okay. Dispositions then. So what constitutes a taxable disposition of a life insurance policy? What events create a taxable disposition? Perfect. Yeah, good start, Chris. A surrender of a policy. And we have two kinds of surrenders. We can have an absolute surrender, and that's where you give up the whole policy. And then you're just going to look at cash surrender value minus ACB. That's real easy. And then I can have the far less common partial surrender. This is the kind of thing the Act spends a ton of time on that virtually never happens in real life. This is where you give up a portion of your death benefit or reduce your death benefit and remove a similar portion of cash from the policy. Okay, and it's taxed proportionately to the absolute surrender. So for example, if you reduce your death benefit by 40%, then you're going to deal with all the associated tax consequences. You would pay 40% of the tax of an absolute surrender, a complete surrender. Okay, you would have your ACB reduced by 40%. Okay, everything would be 40%. That's good? Oh, and you would get 40% of the cash. Okay. What else could happen that could constitute a disposition? Perfect. If we have an assignment of the policy, an absolute assignment, not a collateral assignment, you actually have to have a change of ownership, a true change of ownership. Okay, a collateral assignment is not a change of ownership. It only gives an entity ownership of the death benefit. Now, there are some exceptions. What are the exceptions here? There are sort of two sets of exceptions that apply. Okay, the biggest one is between spouses. Okay, and here, this rollover always applies. So between spouses, we can always transfer property, capital property, life insurance contracts, whatever it is, all transfers just fine. What's the other one? The one you probably do more often, or at least plan to do more often? In fact, I want to specifically talk about what that one, Chris. I'm glad you mentioned it because it's not allowed, not as a rollover anyways. We'll come back to that in a second. To kids, that's the other one, Danny, right? A simpler one that's very common, right? Okay, now to children and grandchildren, I will emphasize this, okay? Not nieces and nephews. There are some other tax rules where we do bring, such as attribution, where we bring nieces and nephews into this, but this is only children and grandchildren, okay? Adoptive children, stepchildren, the whole sort of range, but not nieces and nephews. Now, in order to do this, the child must be the life insured, or their child must be the life insured. So if grandparents take out an insurance policy on the life of a grandchild, that's good. Everybody's with me there? They can transfer that policy to the parents on a rollover basis. That's fine. Okay. And you can do this to the, let's say I want to transfer the policy not to my son, but to my daughter-in-law. I could do that as well. That's perfectly fine. Okay. Any questions there? Perfect. And just hang on a second here. What am I missing? So this is done at the transferor's ACB. Basically, the child just inherits the tax consequences. Okay. Now with corporations, I should mention here, this is a really useful tax measure. I don't think people sometimes think about how useful this is. It's very difficult to follow all the rules properly and invest in, let's say, a non-registered investment account using, say, a mutual fund or stocks and bonds on behalf of a child, you have to use a trust that's properly set up. You probably run into some attribution problems, and you probably have a disposition of that property when it's transferred to the child's hands. But with life insurance, you circumvent all of that stuff, okay? And we don't talk about it much here. We'll talk about it later on, but you also can consider that you can name a contingent owner on such a policy, which means you can get that thing to not enter into the estate. You can just have it pass right to the contingent owner's hands. Okay, between corporations. So we'll talk about this again in course 256, but if you go from OpCo to HoldCo, okay, which you can do a tax-free intercorporate dividend as, you can't make that work here. This actually becomes, it's two things. It's a disposition for OpCo, and it's a taxable shareholder benefit to HoldCo. So it has that kind of double whammy. And then I don't know why you would ever do this, but if you wanted to go from HoldCo to OpCo, okay, that would be a disposition for HoldCo. And the problem here is that your set of intercorporate dividend rules are very specific to the type of property that are impacted, and it doesn't include life insurance. Okay, so life insurance is not under the normal set of rules here for these intercorporate transfers. Okay. Any questions there? All right. What else can constitute a taxable disposition? Well, technically, it's not a big deal generally, but if the policy lapses and is not reinstated, okay, so just bear with me for 1 second here. Okay, yeah, sorry about that. So if the policy lapses and is not reinstated, that is a taxable event. And then we also bump into a problem, a taxable disposition. Actually, I don't want to say a problem here, I shouldn't say that, but on death, okay? There's no tax to pay unless you have a non-exempt policy, but the thing to consider here is that it's basically a cleanup of the ACB. So death is a taxable event, but there would be no tax to pay. This really just kind of eliminates any tax consequences for that policy, okay? It's an administrative provision, not an actual tax generating provision. We talked earlier about a policy that fails the exempt test, okay? And then there's this kind of weird provision. Actually, I'll cover it on the next slide here. Okay, any questions so far? Talk about policy loans and then some related stuff here. Okay. So keeping on with our dispositions, the next we'll talk about is the policy loan. And to be 100% clear here, this is a loan from the insurer using your cash surrender value as collateral. Okay. So I'm borrowing money directly from the insurer. It's not a third-party loan or anything like that. And I'm going to collateralize now my CSV. That's good? Okay. And when I do this, I can borrow up to the ACB tax-free, and over that, it's taxable. Has anybody ever actually done a policy loan? I hardly ever see them done. Danny, you would see some, obviously, right? Yeah, but not very common, are they? Now, what happens with my policy loan? Let's say that you have cash surrender value at $60,000 and an ACB at $25,000. Okay, so you can borrow $25,000 without a problem. And then when you repay it, so that's going to reduce your ACB. And when you repay, it restores the ACB. Okay. Any questions there? That all makes sense. But let's say you borrow $30,000, just for the sake of argument. Well, $5,000 of that is taxable. And now, when you repay, the first $5,000 is actually tax deductible. So you basically undo the consequence of that earlier loan, then the next $25,000 restores the ACB. So when you repay the loan, we're going to bring the loan amount, we're going to bring the first portion in as a tax deduction, and then we bring the ACB back up. Any questions there? Now, we also look at interest on this loan. Okay, and this depends on the reason for borrowing. So if you borrow for personal use, then any interest that you repay, so if you actually pay any interest, which you don't necessarily have to, we can accumulate the interest usually on these loans, would increase the ACB because it's a contribution of your tax paid dollars to the policy. That's good. Whereas, if you borrow for business or investing use, it's a little bit different now. So if you borrow for business or investing use, your interest is deductible, even if you don't pay it. And I think people don't necessarily recognize that sometimes, that interest is deductible on investment loans, whether it's paid or payable. So even if you're capitalizing the interest, you still can get this tax deduction. Okay. And then it does not increase your ACB because you're not contributing your tax paid dollars to the policy. You would be contributing your pre-tax dollars to the policy. Sorry, it does not increase the ACB. Okay, that's good. Any questions around policy loans? I find this is kind of a lost art, that because we see policy loans so rarely today, that we overlook some of the tax considerations around them. And I especially want to emphasize, I think this is actually quite useful in some circumstances, the fact that your interest is deductible even if you're not paying it. Okay, good? Okay. So then, what's my next disposition? We can talk about another somewhat complicated thing, an annuitization. And again, this is one of these things that never actually happens. It probably happened at some point, but never happens today. This really acknowledges how whole life policies were structured in about 1965, okay? It's actually kind of curious, you brought up earlier your credit rider, Danny, because that's actually what used to happen with whole life insurance. Whole life insurance used to have a sort of disability provision built into it where you wouldn't have a separate disability policy, but if you became disabled, your whole life policy might pay out 10% of its face amount every year or some amount like that. So this annuitization never happens, but it is covered in the Act. And basically, if you annuitize, that is, you turn your cash surrender value into an income stream, it's immediately taxable. And you would just do CSV minus ACB, just like all the other tax calculations. But if the policy owner, and note policy owner, not the life insured, but if the policy owner is disabled, then the tax is spread across the life of the annuity. So you would now smooth out that tax bill over the number of years over which the annuity would be paid, okay? But I never see that done. Okay, that's good. All right. And then the last we'll look at is dividends received. So dividends are a little bit tricky here, but if you have dividends paid from your policy, they are taxable when paid as cash. But the first thing that they would do, they would reduce the ACB. So you only actually pay tax on them you only pay tax on a dividend when the ACB is 0 and a cash dividend is received, or a cash type dividend is received. What's of course way more common today. Anybody do any par whole life? And what do you normally do, Chris? I'm assuming here with most par whole life today, it's what I almost always see. Yeah, you always do paid up additions, right? And there you don't have a dividend paid as cash. So if it's used to buy more insurance, that's a little bit different. Basically, that's a wash from ACB purposes. What happens here is because it's used to buy more insurance, it's a contribution back to the policy, and therefore it's a wash. It's basically an in and out type transaction. Okay, so it doesn't increase your ACB, it doesn't reduce your ACB, it just keeps the ACB the same. Okay, kind of like you took the money out and then reinvested it back into the policy. All right, that's good. Any questions at all on dispositions? There is one thing that we have not covered yet. I'll come back to it in a moment. Okay. So we covered off our assignments already. We talked about deductibility of interest. So this is one I find, I don't know if you're following along here, but this is on page 2-22 of the text. Oh, on that note, actually, who didn't have their text yet last week? Was that you, Taylor? You do have your text. Chris, do you have a text? I learned this morning that the text ordering is optional now. I didn't know that, so. Yeah, there you go, okay. So I find that, so on 2-22 of the text, there's this, I find it confusing. I didn't understand at all what they're trying to say here. And I assume it's James that wrote this. I didn't understand at all what the top of page 2-22 meant. So I actually went to the Manulife document on the same topic, and I found it much clearer, okay? The gist of it is that you can transfer this policy into a trust, but you're not using the trust rollover rules. You're using the normal property rollover rules. Okay, so only if another rollover would apply. Okay, so an example of this would be if I'm transferring a policy into a trust that has nieces or nephews as beneficiaries, then I have no rollover available. Okay, but if it only has spouse as beneficiary, then a rollover is available. And only a child is beneficiary, then a rollover is available. Okay, and the question, which is really a question for the accountant anyways, is only what provision of the Income Tax Act am I using to achieve that rollover? So I've given you the link here. You can go read that particular RepSource document from Manulife. I find these are good documents that are usually publicly available. Sometimes Manulife sneaks them behind a firewall for a time, but somehow they always come out. Okay, that's good. All right. Okay, so now we're going to switch gears a little bit, and we're going to look at split dollar arrangements. Anybody ever do a split dollar? Danny, did you ever see a split dollar? All right. Is it a small number of agents doing a lot of split dollar? Is that what you've got? And not CI. We'll talk about CI later on. I mean with a life insurance contract. Yeah, I thought mostly CI. That's where I see most of it. I want to just focus on life insurance now. We'll come back and talk about this with CI later on. Yeah. So a split dollar life insurance contract. This used to be very, very common. You used to have this done very often as a sort of source of shareholder compensation. It's still allowed, but I hardly see any of it done on the life insurance side. Okay, and under this split dollar life insurance contract, you're going to have one of two things. There's a split dollar or sometimes a reverse split dollar, okay? And there are two ways to do this. So in scenario number one, the company is buying a key person policy, okay? And it normally would buy term. But in this particular scenario, the shareholder, or the key person, most likely a shareholder, so the key person has an investment need. Okay, they're maxed out on TFSA, RRSP. Okay, and they are going to now set up an account value associated with this policy. And that's a split dollar arrangement. So you can see the origins, Danny, of what you're talking about, right? The CI with return of premium in this very, very old structure. That's good, and it's quite similar, isn't it? And so now the idea is that the death benefit is owned by the corporation and the investment is owned by the key person. Okay. And then the other version of this is that a shareholder will say has an insurance need, okay, and is going to buy this insurance personally. But the corporation has a bunch of dollars, and you'd most likely see this in a scenario where you have 4 or 5 shareholders. You probably don't see this with just one shareholder. So the corporation has a boatload of cash on hand, and so the corporation funds the account value, and now you have the opposite. You have just the opposite of what I illustrated above, where the death benefit is owned by the shareholder and the investment is owned by the corporation. That's good. And these structures, these have been around for a very long time. These are accepted structures. Everybody is paying fair market value for what they're getting. So there's no sort of abuse or manipulation here. And really, the set of structures we have around this, CRA has not expressed any kind of concerns around. This is certainly one of the kind of building blocks for the CI with return of premium, and it's one of the reasons that people who are involved in that market have some confidence that what's happening there is not offside. Okay? Any questions there? All right. Okay, how about then our death benefits? I talked about this a little bit. I think I talked about this enough already. Actually, I got to think if there's anything else we have to cover off. Oh yeah, I did want to show you one more thing here. I mentioned this briefly once already. The specific thing I wanted to talk about here, it's not really even a death benefit issue. It's the third party ownership of a policy. Okay, so let's say that, how are we going to do this? Good. Jim and Ann are partners in a business, okay? And it's a partnership, okay? No corporation for whatever reason. Okay, maybe they didn't want to incorporate, maybe they couldn't incorporate, whatever it happens to be. And Jim owns, let's say, maybe they're both a little bit older, and they bought permanent insurance for whatever reason. So Jim owns a $500,000 whole life contract on Ann's life. They're not married to each other. He is simply concerned about what happens if Ann dies while they are still in business together. Okay, and this $500,000 whole life contract, we will say at this time, it has an ACB of $50,000 and a cash surrender value of $80,000. Okay, that's all good. And now, Jim dies. Okay, and let's say that the policy in this case transfers to Ann. What happens here? And this is a non-exempt policy, by the way. Sorry, this is a post-1982 policy. Pre-1982, there was no tax in this event. Okay. So the policy transfers to Ann. What happens here? Well, this is a disposition for Jim. And because of this disposition, Jim's terminal tax return has a $30,000 taxable policy gain. And now Ann inherits the policy with an $80,000 ACB. Exactly, Chris, right on, yeah. Ann inherits the policy with an $80,000 ACB. You just applied your basic tax principles there, Chris, nothing fancy, right? Now, depending on how this was set up, there's not really a tax question, but if Anne were the successor owner that is named in the policy as such, then this is not probatable. Okay. On the other hand, if this had gone through Jim's will or some sort of buy-sell structure, then this would be a probatable asset. Okay, any questions there? Conversely, if this had transferred to Jim's wife, then a rollover applies. Then you would use the spousal rollover. And the policy would have an $50,000 ACB. That's good? Okay. Does that all match up with our understanding? I don't find so much sort of third-party ownership of a policy like this anymore. I find most third-party ownership of life insurance contracts is in corporations, and the corporation wouldn't die, right? That we talked earlier about transfers out of a corporation or whatever, or parents and children, and there, again, it's less of a concern. It is important in that case to name a successor owner. Where I find sometimes that gets overlooked is where grandpa dies, leaves the policy to son, who is the policy owner on the original grandson's policy, and dad never fixes the ownership structure. Dad never sets up a successor owner. Okay, any questions there? All right. So now we get into a fairly complex concept. I'm not sure why they included this in the personal ownership section, okay? We already did talk about a little bit of insurance leveraging when we talked about those insured retirement concepts. So I'm gonna go into a little more detail than what's in your textbook here. And we're gonna start off with talking about 10.8. And I'll still use this word 10.8, even though technically true 10.8 doesn't exist anymore. That's right. Danny, am I okay to say that? Okay. But versions of it still exist, don't they? Now, I know, Danny, you would have been involved in some, would you have been involved in some 10.8 implementations? I'm not sure, actually. I don't know what your vintage is. But Taylor, Chris, any 10.8s in your history? Yeah, we're going to talk about Iris on the next page, actually, Danny. Okay, so, and Chris, any 10.8s in your background? I'd be surprised, just given, I don't think Investors Group has generally been a fan of this concept, so. Yeah, that's probably fair. So there is a place for them, right? But I do find, yes, they have been sort of oversold. So the idea here with the 10.8 would work like this, that you're going to purchase a permanent contract. Okay, that's good. And you're generally going to, it's probably YRT. Okay, you're going to max fund it right up to MTAR. That's good. You're going to get a guaranteed rate of return in the contract, okay, which might be 8%. And then you're going to take out a loan from the insurer, not a policy loan, although I have seen this structure with a policy loan. Generally, you're not doing this as a policy loan. Okay, so you take out a loan from the insurer, and you're going to be at a 10% rate for the interest on the loan. That's all good. And then you use the proceeds of the loan to invest somewhere else. Okay, doesn't really matter where else, as long as it's a non-registered investment with an expectation of profit. And then you can deduct that 10% interest. And it works well if you're at a high tax rate, because the spread here is 8% tax deferred income is better for you than 10% tax deductible interest. Okay, the cost of that 10% tax deductible interest when you have a 45% tax rate, for example, is really only an effective is just going to be 5.5%. Okay. Is that a fair description of the old 10.8? So what happened then in 2013? Oh, I can't remember the year now, I'm sorry. I believe 2013. If it's 2014, I apologize, but I want to say 13. The Income Tax Act changed, and it said, if you link the two rates up, that you don't have you can't deduct the interest, sorry. So basically it prevented you from linking the two rates. And it wasn't just 10.8, there was 9.7, so there was 10.8, there was 9.7, there was 8.6, there was a 6.4, and a 5.3 version of this. There was a bunch of different versions of this depending on what insurer you were dealing with. So now, and I think if I remember right, Danny, IA was the first out the gate with this solution, weren't they? So now you have unlinked rates. And what happens with these unlinked rates is you would do, for example, on the investment, you would have a guaranteed return based on some minimum deposit or whatever the case is. You'd have a guaranteed return of prime plus, say, 3.5%, but add 2.5 will go. Okay. And on the loan, you would have a guaranteed rate of prime plus, let's say, 4.5%. Okay, but the two are not contractually linked. And the idea then is you would have people who are buying the investment just for its sake without doing the 10.8. Okay, I do think it can work. I don't think the 10.8 is universally to be lambasted or whatever the case is, but I think to your point, Chris, I saw a lot of it done in situations when I don't think it made a ton of sense. It goes back very much to my comment earlier about the insured retirement strategy, that this whole thing hinges on using leverage. That's right. This is leverage. And now the question is the client a suitable candidate for leverage? And in many cases, I would suggest they were not. The problem here is that generally to make this work, you have to have a real long-term commitment to that leverage. That is, you have to keep borrowing to invest in order to get them to squeeze the most out of your 10-8. Okay? And it really hampers any sort of exit strategy for the 10-8. So the problem here is you likely now are leveraged until you die. Okay. I know there are other ways to do this, but honestly, that's what I almost invariably find with 10-8 is we set this person up to be leveraged until they die. And then the question becomes, hey, you got an 85-year-old. Should that person still be leveraged? Because one day your client is going to be 85, or you've got a 95-year-old. Should that person still be leveraged? And this to me is one of the concerns around 10-8, is I don't think that we necessarily think about the very, very long-term implications of this. Okay. I believe not just with this, with any leverage strategy, whether it's an RRSP loan, just a short-term RRSP loan, right up to big dollar investments in order to fund the start of a business. I believe any leverage, one of the keys is exit strategy around that leverage. How are you getting out of this? And I think sometimes we don't think about that in this kind of thing. We really look at a sort of short-term benefit. All right, that's my soapbox. Good? Okay, and I don't think that, like I say, I don't think 10-8 is always bad. I just don't think that we sometimes think about our long-term implications. Okay. And definitely CRA has had problems with 10-8. CRA has sniffed around them for a long time, and those tax changes we saw, I would suggest, were largely initiated by CRA wanting to close out some of those 10-8s, thinking that there might be some inappropriate stuff happening there. Okay, so then we get in, this is a little more complicated. 10-8 I find is complicated. This I find is a little bit more complicated, okay? And it's not in your textbook specifically, but it relates to what's in your textbook on page 26. This is the zero cost or immediate financing, or, yeah, sorry, Danny, I should have given IRIS, right? Oh no, I can't remember what IRIS stands for. I've lost it. Help me out with IRIS, Danny. Anyways, the concept here is that you have a corporation. So your corporation has an insurance need. Okay. That's good. And considers term insurance, but we look at another option. And that's generally what you'll see here. You'll see sort of this illustration done where we say, hey, if you buy term insurance, it's going to cost you this much. And if you don't die, it doesn't do you any good. So we look at an alternative permanent insurance solution. And the way this thing is going to work, we acquire some permanent insurance in the corporation. Now, with this permanent insurance, we're going to max fund it in the first year, and generally it's going to be a YRT. Whoops, YRTUL. Okay. That's all good. Nothing fancy so far. And the insurer allows typically 100% of that cash surrender value, which is going to be most of that first year's premium, to be used as collateral. And this all has to be set up. You can't just sort of wander into this. The insurer has to be along for the ride here. Okay, still all good. Now, there are a couple of different versions of this. I'm going to show you what is probably the more aggressive version. That's okay. So now, my shareholder borrows that money using the cash surrender value, which is a corporate asset, as collateral. Okay. So now we have our shareholder actually doing the borrowing. Now, in order to not trigger a shareholder benefit here, the shareholder pays a reasonable guarantor fee to the corporation. Okay. That's all good. And that would be, that's taxable income to the corporation because it's income now. Okay. And potentially it's deductible for the shareholder. Now, there was just an example of one of these that went through the tax court and it had all kinds of problems with it. Okay. In this particular case, the shareholder borrowed, I can't remember the exact amount, but it was about $400,000. So it was a fair amount of money, not a tiny little slice of cash. And the shareholder borrowing that money paid, I want to say, a $400 guarantor's fee. It was substantially less than 1%. Now, Danny, where you've seen these, right? You actually participated in an IRIS placement. Would I be right there? I don't know if you do or not. I don't know if this all gets shuffled off to Brenda or whomever. Okay. $400 is probably not enough to constitute a fair market value for this guarantor's fee. Okay. So this is usually going to be 1% of the amount borrowed. That's what I've seen. I've seen 0.5%, but 0.1% is certainly not appropriate. Okay. It's actually a really interesting case. There's all kinds of weird stuff with it. You can see how it fell under CRA's radar. I'll talk more about this later on. There's an offshore reinsurer involved and some other weirdness with it. Okay. Anyways, now you have the shareholder uses that money to invest. Okay, that's good. Now, the shareholder in this case pays interest to the lender, okay, and that's tax deductible. That's good. Now, sometimes you're going to borrow. There's two different ways to swing this, okay? It may be borrowed from the insurer or from the corporation. And if it's borrowed from the corporation, then really what happened is the corporation borrowed that money. So there's kind of two different ways to pull this off. That's all good. And now what happens is the shareholder has this big tax deduction. When you see the numbers associated with these things, the numbers can be stunning actually, because mathematically, like most leverage, this works out really, really well. It can be very slick. What you end up with here is by year 10, the shareholder typically has a massive loan outstanding. And that massive outstanding loan now generates a huge tax deduction. And that big tax deduction allows the shareholder then to take a ton of compensation out of the business for free. This is why we call this a zero cost arrangement. Okay. Really, what ends up happening is you pay very little for your policy. And then you have this sort of long-term plan to have this win-win-win. So long-term, you're going to have the corporation get a death benefit. And when the corporation gets that death benefit, that's going to create a CDA credit. Okay. And then we're going to pay that all out tax-free to the shareholder. And this becomes your exit strategy now, where the shareholder now has the opportunity to use that to repay the loan. Now the shareholder's dead, right? So that's done via the estate. That's good. Okay. Does that make sense? All right, you always need some sort of Excel spreadsheet to support this. Honestly, the amount of outstanding loan that you end up with on these things, it is typically quite surprising. It can be hundreds of thousands or millions of dollars by the time this is all said and done, all supported by this big cash surrender value that's built up in the policy. And that's where you get this really big tax deduction. I don't mean a $10,000 or $20,000 tax deduction. You'll see hundreds of thousands of dollars in tax deductions here sometimes. Okay, that's good. All right. Now, what's the problem here? What kind of policy owner would look at this kind of thing? Or what kind of business owner would be looking at this? Would you sell this to somebody in their 30s, for example? Normally? Yeah, you'd have an established person, high net worth, right? Probably a business owner, Danny, in their 50s, for example. Would that be about right? Okay. Because in their 30s, even if they have great cash flow, you have a lot of long-term uncertainty. You're not sure if the business is going to stick around for that long. You really have to make a commitment to the business to make this thing work. That's good. And because of that required sort of commitment to the business, this doesn't work well for that younger person, Now, what's the problem when I get into insuring, let's say, 55-year-olds? Okay, underwriting, absolutely underwriting is going to be a problem here, right? And you'll see this sometimes where an agent, and these are typically big fish policies, so the agent spends maybe 8 or 10 months in a sales cycle working up to, let's say, I'll go with a relatively small one, let's say a $10 million face amount. It's going to be a UL contract, so we know it's going to be a big payday on this thing. And the agent puts the client through underwriting, and the client gets to the stress test, and we find out that there is some high blood pressure, hypertension, whatever, and the insurer either comes back with a 300% rating or comes back with a decline. That's good. And now the agent is banging their head against the wall. They say, oh my goodness, that was so much work, and now it's all going to come to naught. That's right. So underwriting is a problem here, and the insurer should be doing underwriting. I'm not suggesting that the insurer is not in the right rating or declining that person. But here's where it gets clever. So the agent says, well, this person has a need for insurance. Now, really, are we selling this thing because you need a big death benefit? That is, Danny, if that established high net worth person at age 55 dies, is their family going to be scrounging for coupons to be able to pay for groceries now? It's not the case, right? You're really selling this as a tax tool. That's right, as leverage, okay? It's going to be the basis for leveraging, okay? So once we recognize that, we say, well, really, what does the insurance have to look like here? And this is where we start to see some of the creative stuff that happens when we get into these big dollar policies. So this person fails underwriting now. And we say, well, whatever, IA won't help them. So we're going to go a different route. We're going to go with what's called the captive insurance market. And I know captive insurance refers to one thing. I know Sun Life agents are a captive agency. That's not what we're talking about here. What you're going to do with captive insurance is typically you're going to get an offshore entity, and that offshore entity will register a Canadian insurer for you. So it'll be in whatever province is easiest, and I don't know what it is depending on the particular circumstances. They'll register a Canadian insurer, okay? That Canadian insurer is going to do one policy. Yours, okay? We'll set up an offshore reinsurer. And now you'll pay your premium. They will underwrite your policy. They don't care about risk. Okay, that's good. They'll underwrite your policy. You'll max fund it. The death benefit is only going to be based on the funded amount. So the death benefit actually paid is only based on the funded amount. There's actually no real insurance here. It's an insurance contract, but there's no actual insurance associated with it. You could, if you wanted to, you could use Lloyd's or somebody like that to actually sell you the life insurance here if needed, but really a lot of times these things are just set up as there's a sort of hypothetical insurance contract, and that's it. That's good. So this is something that I see done in those, like I say, those big money cases. I know a few accountants that deal in this world a little bit. You'll see this from tax lawyers. When you get into the more sort of exotic tax lawyers, they'll deal with this kind of thing. It is pretty complicated. There's a lot of administrative costs and honestly a lot of commissions that are typically collected here. All right, that's good. Okay. Is that insurance? I would argue that there's no insurance happening here at all. You're really just using an insurance contract and the provisions in the Income Tax Act to get a couple of tax benefits. Okay. All right, let's go to annuities then. And I will after lunch, I'll show you a case. I'll show you a captive insurance case. And it's really something. There's a couple of useful provisions out of it. Okay, so our annuities here. So annuities today are very simple. If you have, assuming it's a non-registered annuity, it's all taxed on an accrual basis. Meaning that every annuity payment is a combination of interest and principal. And that's just a straight interest calculation. So for example, you invest $100,000 to buy an annuity. There's an annuity rate, which is something that the insurer never tells you. You typically have to figure this out. The annuity rate is, let's say, 3.5%, okay? But the annual income is, let's say, $100,000. Annual income on this is $7,500. So you know in year one, very simple here, in year one, you've got $100,000 times 3.5%, you got $3,500 of imputed interest. That's what's going to be taxable. You're going to get a T5 to show that, which means that $4,000 of the income was principal, which puts you down to year two, $96,000, and you can just work your way all the way through this, right? So year two now, you've got $96,000 times 3.5%. So now you'd have $3,340 of, sorry, $3,360 of interest income. And a little bit more principal, you'd have $4,140 of income was principal. And it's just going to keep going like that. Theoretically, if you live long enough, you could end up in a position where there's no more interest paid at all. Or very near zero. That's right. So that's your sort of off-the-shelf, generic, non-registered annuity, and nothing fancy, very, very simple. If you've got a registered annuity, that's even easier, right? What's taxed with a registered annuity? this is bought with an RRSP or a RIF or a LIF, possibly with DPSP money. Here, everything is taxable. Yeah, that's right, Danny, right? Nothing fancy. Okay, now in the past, and this is one of the things that's a little bit confusing in your textbook, maybe with annuities, because you read the textbook around annuities, you say, well, why do I need all this detail? In the past, there have been other annuity taxation regimes. Annuities used to have deferred taxation. So what used to happen here was you used to have 7 years of deferred taxation. You used to be able to generate annuity income for 7 years and defer it. And then for a brief time, for 3 years. This all went away in I want to say 89. Forgive me if I have the year wrong, but thereabouts. So really old school insurance agents will have sold annuities and used that sort of tax deferral. And really, I don't know what the logic was to the tax deferral. I guess it made retirement planning easier, certainly more complicated, because now you have this tax hit every 7 years. But I don't know what the sort of policy benefit of this is. Okay, again, this may be a nod to the lobbying power of insurers at one time. Okay. Any questions there? Perfect. So this leads us to the slightly more complicated, but not that complicated, prescribed annuity. So the prescribed annuity, it's a non-registered annuity. Now, technically, a prescribed annuity is any annuity with level taxation. So under that definition, technically, a registered annuity is a prescribed annuity. So even though we kind of in common language say prescribed annuities, the proper distinction here is between an accrued rate annuity or an accrual annuity. And that's where every subsequent annuity payment is a decreasing amount of interest income with each passing year, okay, versus a proportional taxation, versus, yeah, I apologize, sorry. Yeah, proportional taxation annuity and the proportional taxation annuity levels out the tax bill for a non-registered annuity. This used to be very favorable. Whether it stays that way or not, I don't think this really is that good anymore. Under the old rules, the problem was that we used a really outdated mortality table. And so what would happen under the old rules, you'd have this scenario, and this is exactly how it worked. You'd have a, let's say a 72-year-old buys a non-registered annuity, okay? And has, for the sake of argument here, $200,000 of principal. All right, let's say, for the sake of argument, that we're working at a 3% annuity rate. which is about what you'd be at today, and is promised here. Just bear with me for a second here. Should be about $620 a month per 100,000. So about $14,880 of annual income. Okay, in that vicinity. Now, this has to be non-registered in order to do this. So, it has to be, there's a bunch of rules. So it must be non-registered, which only makes sense. Can't be indexed. If it's joint, it can only be joint between spouses. Can't be corporate owned. Okay, a bunch of very prescriptive rules around this kind of thing, but that's fine. So what would happen then is under the old rules, you would say mortality for our 72-year-old is estimated at about age, we'll say about age 81. Okay, that would be about right. So you would have 9 years of annuity payments times $14,880. Okay. Well, that's not enough. I think I screwed something up there. Just give me 1 second here. My rate might have been too low. No, that'd be about right. Yeah. Okay. My age is too low. Just bear with me for 1 second here. Sorry, just 1 second. I've screwed up my math here. Yeah, we'll go 15 years. That'll work. Okay. That actually works out pretty cleanly. All right, so we'll say mortality is estimated not at age 81, but estimated at age 86. And that actually is probably a little bit better. Okay, so what we would say here is you're getting 15 years, and that's what I couldn't make work. Sorry, 15 years at $14,880. That's $222,000 of total estimated annuity payments. Which means if you started off with $200,000 of principal, that effectively $22,000 of this is interest if you live until your expected mortality. And now we would say, all right, $22,000 divided by that 15 years. And every year you're going to have $1,467 of interest of taxable income. Instead of the roughly $3,500 that I used on the last page. Does that make sense? Now, with the new rules, nothing really changes except we use a more updated mortality table. So under the new rules, we use an updated mortality table, and it's adjusted for your particular mortality. Sort of like we saw in CPI earlier, is adjusted to your particular health. So this updated mortality table is adjusted for your mortality. Okay, and what would happen now is you might use an estimated mortality age of, let's say, 91. That'd be about right, I think. And so now you would have same calculation, but many more years in here. So you do 20 years at 14,880. And now you can see you get 297,600 here, minus $200,000, so 97,600. Now divided by 20 years. And we're going to have 4,880 of taxable income each year. So you've about tripled the tax bill for adding that 5 years of mortality. And that is really what's happened. That's about representative of the true effect of the changes in prescribed annuity taxation. It doesn't necessarily kill the prescribed annuity, but you can see that's a big difference, right? I've effectively brought a third of that annuity payment into income versus 10% in the previous calculation. Okay. That's good. Is there a little bit of logic to that? Okay. So I think that's a good time for a break. I have 11 minutes to the hour. And we'll take 41 minutes, I guess. We'll resume at past. And we'll see you back then. Thanks.